We don't know if it's live. It's not live. It's 71 degrees. What happened to this dog days of summer here, Tony?
Beautiful sleeping weather.
Oh yeah, open the windows up a little bit, turn your AC off, let some of that smoky air get in there.
Yeah, I'm happy with it though. I like it. It was a little too much for me in the last couple of weeks, a little swampy.
It's as a fellow hot-blooded Italian, same situation going on there. It's been a couple weeks since you've been on. Any fun trips? I saw you maybe go see Bush the other day.
Yeah, I went to the Virginias and I went to the Summer of '99 concert at Tinley Park, which was an interesting. I mean, there was very little that resembled anything of 1999, except maybe the music. It was expensive, it was crazy expensive. Everything was monitored, recorded, tracked, cashless. I'm like, I really don't think anybody in the actual spirit of '99 would have gone for this. Probably would have raised hell and burned the place down. But that didn't happen, and I had a good time, so that was it.
All right. So summer of '99, we as we were planning this episode, we'll talk about the other 99s, like the 1099 you might get at closing when you sell your house. So capital gains.
Good carryover there. All right.
I was really stretching for that one, but that we got it. So I think you hear people, don't sell your house, you're gonna get crushed with capital gains tax. Is that true? Is it false? Is it a big myth, Tony? What's fact? What's fiction?
Well, you're the money guy, so you're the guy to ask. But we do hear it. I've heard people like, well, you don't want to sell that because then you're gonna have to pay the tax. And I'm always like, what are you talking about? There's a misunderstanding in the market, and I understand flying around social media right now about capital gains on the sale of your real estate. So how does it work?
Well, I think the biggest piece of what works with it is when you sell your property, the title company, a lot of times you've heard this question, right? They're asking the seller some questions. Have you lived in this house for this long? Because they're determining if they're going to give you a 1099, I think it's a 1099S or a C. And that is just going to show the proceeds from that sale. Now, that doesn't mean because you received a 1099 that you have created a taxable event. What it means is you just have to report on a form and then mark that in this case, right? You've lived in this house. We'll talk about a couple big rules here. You've lived in this house as a primary residence for 2 of the last 5 years. It doesn't have to be 2 concurrent years. It could be, year 1 and year 4, and then you sold the house as long as you didn't use it as investment property there.
Now, we're not tax advisors.
Oh, yeah, I forgot. Hold on. We got to read the disclaimer. This episode is for educational purposes only and should not be considered tax or legal advice. Always consult with your CPA or tax advisor.
Exactly.
Thank you for the reminder.
But most simply, the rule is 250, 500. And it almost doesn't apply to anybody. What does 250, 500 mean?
So 250 means if you are a single tax filer, you have up to an exemption on the sale of a primary residence of $250,000 of gains. So as long as your home, for lack of a better description, hasn't appreciated by more than $250,000 from when you bought it, you're not going to pay any capital gains tax. Again, it has to be primary residence.
If you're married, it's $500,000. Now, this is profit on what your basis was. All right.
Yep.
So what's considered your basis? That's your acquisition cost. All right. Plus any of the improvements and things you've made, a roof or whatever. So I'll give you a quick, for instance. So if we bought the house for $400,000, all right, and we put a roof on, maybe that was $25,000. Now we're at $425,000. We did some other work. We're up to $450,000. We've got it to $250,000 over that. All right. So what is that? $650,000 to the $700,000. All right. So now we'd have to be selling for $700,000. We can back out real estate commissions, back out all sorts of stuff. And the tax would be on the profit over that amount. Okay, so let's call it $700,000, and let's say you did it. All right, say you sold it for $800,000. All right, there'd be a difference of $800,000 to $100,000. It'd be $100,000. This is a very rare instance. Who in this amount of time is going to sell for this much?
Probably nobody.
All right, and that's for a single guy. Now, if you're married or single gal, if you're married and you're filing jointly, it's $500,000. So that $450,000. All right, now we're at $950,000, and then it'd be a tax on whatever is over that.
So your house had to have doubled in value from when you bought it. right? And then you also factor in, I think that's the big thing you brought up there, is the basis isn't just the purchase price of your home, it's your purchase price plus capital improvements. So that does reduce the, or I guess it increases the number that's being subtracted from your sales price, which factors into that gain thing. I think one of the reasons this is flying around social media again is, you know, we had this making home affordable initiative, and there's no homes for sale, and boomers are sitting on all that damn equity, got to sell that damn house, they don't want to pay their taxes. Well, a lot of situations don't actually have this tax implication. So these homes where maybe someone inherited a home 20 years ago, and the basis there was on the we talked about this, the person who died's death date, and it was 200 grand, and now that's 600,000. Again, like, you're going 600 minus 200, that's 400. If you're married, it doesn't even create a capital gains event if you end up living in that house.
I believe with the inheritance, it's 200.
Okay.
Regardless, though, it doesn't apply to very many people at all. As you know, and actually, usually, I hate to say this, but most CPAs I have found will be able to find a way to create enough deductions for you, or to move things around in a manner in which that doesn't apply. There's, I understand there may also be some changes to 1031 exchanges. This doesn't really apply to this conversation. Oh, do we have it in here? 1031 exchanges.
Yeah, look at that.
All right.
So we didn't necessarily do a deep dive in there because there's a lot of technicalities with a 1031 exchange, but a 1031 exchange, again, IRS carve out for a like-kinded property. So you sell a property where you're going to realize capital gains, you can put those sale proceeds into this account that is, I don't know what they actually call those types of accounts, a managed account, where you can't access it until you are going to buy another property in a certain amount of time, so that you end up kicking the capital gains tax down the road.
Correct. I think you have, I forget what the first one is. I know you got to close on it within 180. I think it's find it within 60 or 90. You need to designate what the property will be and then close on it within 180. This is something we don't apply to many normal people, just regular guys. All right. So that's something separate. The bigger thing that I think is applicable to most is capital gains on the sale of your house. All right. In this 250, 500 rule, where and you know, you have to have lived in the property for 2 out of the last 5 years, and it doesn't need to be consecutive time to qualify for this deduction. All right. So it's really not
and there are other carve outs. So if you were in the service, you were deployed, if you had to move for work, there are there's partial exemptions allowed too. There's like 13 paragraphs of other reasons that you can actually get out of it. So talking about this is I can't stress this enough. This is why you have conversations with professionals, not your next door neighbor, unless your next door neighbor is an accountant.
Right. And if you think that's the case, if you think you're going to be subject to it, once we want to get a really good, if you are subject to it, you're in a fantastic position, because it means you knocked it out of the park and hit a grand slam on your investment.
As my accountant would say, it's a privilege to pay taxes.
Yes. So God bless you there. But we'll find out in the early stage of your valuation. All right. Because I'm going to be talking to you about, you know, when you acquired the property, how much you acquired it for. If it is looking like that, I'm going to refer you to a CPA immediately. They can pretty quickly think, if you go to the same guy, or you can get with one of our referrals, they're going to be able to look at your past tax returns and see versus what you may be receiving, and if you are going to be subject to some gain tax and how much. But keep in mind, even if you were, it's only on the amount over that $500,000 gain. All right. What if it might be like $15,000, $20,000? You're paying a small amount of income tax on it, and you just made $500,000. Like, yeah,
I'd take that bet. Real quick, Tori. So we talked about your primary residence and that exemption stuff. In this other conversation about capital gains, though, and being very, very careful and using, again, quality professionals, you transact and you navigate commercial properties all of the time. That is where you need a really, really great attorney, great real estate agent, and your accountant involved in drafting those contracts to protect you from long-term capital gains issues.
Certainly. And if you're using good folks, they will have no problem coordinating. They will understand that this is part of the process. What we find is if you're getting pushback and these people aren't communicating, we need to realign you with a different team. Any proper CPAs and any proper attorneys working in the commercial investment sphere recognize that the coordination of everybody is very important. So if you're getting pushback, that's a sign we need to make a switch. This is also something we want to take a look at on the front end of things. We don't want to be in a transaction and figuring it out then. All right. So these are all of the things of setting up the dominoes correctly so that once we go into selling your property, it's just knocking them down, hit one, and they all fall down.
That's it. So I guess you could say at this point, right? Taxes, paying taxes is a privilege. Tony's accountant.
You're very likely not going to run into a capital gains tax situation on your primary residence.
So taxes shouldn't be the reason you avoid making great real estate investment, right? Like that's
absolutely. There's other valid reasons. Don't get me wrong, but the tax thing, if that's your fear, I mean, get it out of your head, or let us know real quick. We should be able to point you in the right direction and figure it out within.
IRS publication 523 has all of the worksheets. You can run them through. You can, if you are wondering about selling your property, get in contact with Tony. You can Google him. You can spell his name wrong, Tony Mitidiero. He can give you that top level input of what the sales price is likely going to be, and you can figure it out from there yourself. You can talk to your accountant. Just please don't go to these Instagram people anymore for this advice.
You know, the one thing I actually just thought of that's fantastic, though, it's the only nice thing that's ever been said about real estate commissions. The real estate commissions are actually tax deductible. So, hey, there you go.
Perfect reason to sell your house.
708-259-3734.
If you need me, get me at applywithjr.com, and we'll be back in a couple weeks.
I'm done. Cut the show.